They drove silver up to around 85 and then pulled the rug out so sharply it felt like the world tilted. One weekend the chart seemed invincible. The next it plunged like a rock, rebounded sharply, and plunged once more. That was an ordinary fluctuation. That was the market challenging resolve, shaking out the timid and tempting everyone to panic sell. I'm not here to soothe anxieties. I'm here to lay out precisely what this phase represents. A crossroads, not for the price itself, for you. Because when a position turns emotional, most traders abandon probabilities and fixate on discomfort. I'm your host, and this is our space. No executives, no catchphrases, just clear reasoning, managed risk, and the reality as best we can gauge it. And if you're joining us for the first time, welcome. This is where we reason things through. Here's the central tension. Silver just demonstrated it can charge ahead. It reached the milestone. And then it retracted violently enough to make people doubt the whole advance. And now the issue isn't whether silver can climb further. The issue is, do we have the resilience to ride a wild stallion while it bucks? Because silver is that wild stallion. Gold advances like a heavy cruiser. Silver advances like a racer in rough seas. Same waters, same currents, entirely different experience. This surge highlights something key. This isn't a neat, orderly up. This is a trend that penalizes haste and rewards steadfastness. If you crave steady gains, you chose the wrong asset. Now, consider this. When silver had touched 85, some declared, that's the peak. Exit now. Others declared, that's just the start. It's heading to 1101, perhaps 200. Both sides are engaging in the same behavior, just differently framed. They're attempting to master uncertainty by feigning absolute knowledge. We avoid that. We distinguish data from opinion. Data silver surged aggressively, reached a key threshold, and then sharply reverted to the mean. Data. The action frightened late buyers and enticed early buyers. Opinion. The market is forming a formation, not concluding a trend. If you seek to grasp why a formation is significant, picture a compressed coil. Price stretches, then contracts. When the compression builds, the coil gathers force. That force doesn't indicate direction. It indicates magnitude. When it uncoils, it's not a mild progression. It's a thrust. So, what do we do during the coiling? We don't hope. We don't speculate. We monitor the markers. Marker 1 is gold, because gold doesn't chase silver. Silver chases gold. Gold is the power source. Silver is the booster. And gold currently is being sought not out of leisure. It's being sought because global tensions are elevated. The sort of tension that bypasses routine data releases, the sort that appears in reserve planning and international positioning. Plain terms, gold isn't merely a speculation. Gold is a strategic asset. In strife, in mistrust, in disrupted commerce, nations seek something independent of another's pledge. That's gold. It's independent wealth. So when gold firms up, we aren't just witnessing hedging against price rises. We are witnessing escalating strain and authorities gearing up for unpredictability as a norm, not an outlier. Now, reflect on this. If gold has additional potential, does silver remain idle? Or doit s'ouvrir, as the wild stallion, attempt to surge ahead? That's why many of us aren't exiting silver positions yet, but we're also not behaving recklessly. We're handling the psychological pitfall of a massive gain. Because if you entered in the mid-20s and silver is in the 70s, you're holding a return most only dream of. That's where avarice creeps in, disguised as prudence. It murmurs. Keep it for one more big leap. Don't miss out. And that's where the market devastates traders, not through deficits, through remorse, through the agony of seeing paper gains vanish. Key insight. Possessing a large gain isn't equivalent to possessing a strategy. Gain without strategy becomes captivity. The clearest mental exercise is straightforward and effective. Picture waking tomorrow to find your silver holdings closed out at today's level by error. Would you repurchase immediately? If no, then retaining is inconsistency. You're retaining from habit, not belief. If yes, then you're not imprisoned. You're deciding. That single query reveals who's truly positioned and who's merely wishing. Now, let's address what the higher targets really imply. Traders cite figures like 100, 120, 200, utter them, and they sound improbable. But we evaluate figures by framework, not feeling. Silver is a compact market relative to gold. Gold is a vast pool. Silver is a modest one. It requires a little fresh inflow to raise the level. That's why silver can stay quiet for long periods, then erupt in short bursts. It's not sorcery. It's limited availability meeting substantial capital. And here's the stark contrast. All existing silver can resemble one oversized company stock. That's striking when stated plainly. A metal used as currency for millennia, valued like a lone technology firm. That's the imbalance that sparks drastic adjustments when views shift. But we must also acknowledge supply realities. There's silver existing, and then there's silver anthem malleable for trade. Much is secured in forms that move slowly. Vintage items, collectibles, family stores, factory remnants. It exists, but it's not readily tradable like contracts. Insight 3, available supply counts more than aggregates. A huge quantity doesn't protect if it's immobilized in collections, displays, or committed holdings. Now, many will inquire, is entry too late? Here's the blunt reality that preserves capital. If you must ask, it's typically not the moment, because entering a high volatility asset without personal rationale is becoming the counterparty for another's exit. But that doesn't preclude all entries. It means entrants need a viewpoint, risk boundaries, and tolerance for error without ruin. This is instructive. We prioritize risk control. So if contemplating a position, the query isn't, will silver reach one? The query is, if silver falls 10 points tomorrow, do I remain rational? If not, you're not investing. You're speculating. Now, broaden the view. Why are precious metals advancing overall? Because the broader economy is changing phases, and it's noticeable. We have dual drivers that act independent but are linked: geopolitics and manufacturing initiatives. One aspect, heightening rivalry among powers. That supports gold alone. The other, a fresh investment cycle. Label it domestic production, remanufacturing, build-outs, security, tech expansion, whatever fits. The essence, massive funds deployed, much financed through expanded credit. That isn't instant runaway inflation. It is ongoing upward pressure, the type that sustains real assets, the type that elevates tangible goods. Again, if funds are generated and directed into real output, plants, networks, computing hubs, it can be slower to inflame prices than direct spending. But slower isn't absent. It reshapes priorities. So anticipate conditions where metals and raw materials get revalued not solely from alarm, from actual need, which leads to the resource view discussed prematurely: copper. Copper wires, the contemporary era. Computing centers, transmission, converters, drives, automation, all electron movement needs copper. And the tech expansion is power hungry. If committed to advanced systems and mechanization, copper is the constraint you can't bypass. You can't substitute superior conduction at volume. So while debates rage on tech valuations, the reality is basic. Tech demands real structures. Real structures demand materials. Material markets ignore views. They respond to deficits. Now, someone will counter, but tech is overvalued. Equities will collapse. Note, forecasts of collapse recur annually since charting began. If you invest awaiting the ideal downturn, you forfeit long periods of growth. Downturns occur. But the greater error is perpetual caution. We approach markets as conditions. We ready ourselves. We spread risk. We retain flexibility. And here, the tech narrative isn't hype. It's an efficiency leap. The shift that alters growth paths and compels countries to rival in processing capacity as they once did in fuel. That rivalry turns essential. Essential rivalry strains supplies. Supplies strain costs. Costs strain metals. See the connection? Now, return to silver and our immediate choice. What does a sensible trader do when price oscillates wildly after a steep rise? They perform 3 actions. First, specify what disproves their view. If gold weakens and demand fades, silver's booster runs dry. If liquidity constricts sharply, metals suffer, we track those. Second, align actions to personal risk capacity. No need for extremes. The extreme mindset is, how markets reduce grown people to impulsivity. Third, recall that peaks are evolutions, not isolated points. Most explosive phases don't conclude with one reversal downward. They fluctuate, they deceive, they lure re-entry, they eject again. So yes, some aim for the peak, then exit during decline, keeping most gains. That's not my approach, but valid if you endure it. The essence isn't the tactic. The essence is defining your tactic before pressure imposes one. Insight for markets penalize improvisation, intention. Now, a direct question answer in comments as it reveals community stance. When silver reached 85, did you feel thrill or dread? Next, if silver reaches 100, are you trimming some, retaining all, or increasing? Share below. I review them, and the trends inform more than reports. Now, stripping distractions from the source material, promotional elements, offers, contacts, branding, we remove that as it's not insight. It's distraction. Our role is isolating the essence. The perspective sees potential, sees greater potential, but also rational limits ahead. That's balanced. It recognizes upside while noting when it may turn excessive. So how to frame it cleanly. I see a route to 100, to 120, even a scenario for 200, but past that, it relies on frenzy, not fundamentals. That's not pessimistic. That's restrained. Because the aim isn't perfect timing the peak. The aim is realizing gains and continuing onward. Now, touch on oil briefly as it's overlooked. Oil can appear undervalued relative to past inflation. And if energy use rises, tech production shifts, inputs count, but oil is influenced politically. Suppliers have needs. They motivate output. Sometimes costs linger low longer. That's why oil timing challenges valuation spotting. Still monitor it because when it moves, it accelerates. So for variety, diversify beyond assets, diversify motivations, some by caution, some by expansion, some by power, some by conflict, and silver overlaps many. Currency need, factory need, safe flows, speculative flows. It's multifaceted. That's its manic motion. If seeking calm protection, choose gold alone. If seeking amplified gold exposure, consider silver, but amplification works both directions. So no unquestioned commitment. Here's a sensible plan for 2026 from now. Remain varied, avoid chasing spikes. Ignore unsolicited advice. Construct holdings, endure corrections. Approach is cultivation, not chance. Cultivation means seasonal planting, accepting weather, not uprooting daily to check roots. Chance means seeking thrills, and markets gladly charge for that. And the pitfall, confusing knowledge with ability, consuming many views, recalling many figures, feeling prepared. Markets reward procedure. Procedure means sizing, endurance, and readiness to exit when assumptions fail. If you can't summarize your rationale briefly, you're not holding it. You're borrowing it. And when price swings, borrowers react first. We're not borrowing, we're assessing. We're selecting entries with guidelines, exits with composure, sizing for rest. That's sustaining participation. So if holding silver now, the true query, are you holding from understanding the case or because exiting admits fortune? Fortune is acceptable, but ego costs dearly. Now, the disliked topic being incorrect. If incorrect, it appears first, where not in opinions, in gold dropping strategic demand, in constricting liquidity, in shifting to urgent cash needs. So focus on drivers, not chatter, and to continue following, act now. Follow, brief, direct, because this phase will accelerate and you avoid lagging discovery. If this added clarity, engage, not for show, because it spreads straightforward analysis and builds our group. So where are we in a market displaying its character? Silver will surge, silver will crash, silver will test you, and silver will compensate those prepared. I'm not exiting silver yet. Not from excess desire, because gold's power source seems to have distance left, because the broader shift to real assets appears early, not late, and because when the wild stallion charges, you don't dismount from noise, but we're vigilant too. Well, track markers will control risk, and when it shifts from reason to excess, we'll respond, stay focused, stay balanced, and maintain clarity while the chart rages.